Hey guys, we're back here with another episode of the CPA Podcast. We're episode 7. We are going to piggyback off of last week's episode. This week, we're going to focus on the business owners and the tax planning structure, entities, and kind of what all goes into that. So I'll start off. I think one of the main things that I see when we bring on new clients is the tax structure. How they're taxed is not as efficient as it should be. By that we mean, are you a sole proprietorship or are you a corporation, S-corp or a C-corp? The big difference between the sole proprietorship and the S-corp is S-corps don't pay the self-employment tax, as opposed to if you are a sole proprietor, you are subject to the self-employment tax that can definitely increase that tax liability.
Mm-hmm. And the other thing to keep in mind is the distinction between having an LLC and these tax classifications that we're talking about. So if you actually go to the bank and you get an EIN and you set up a business bank account, they're going to tell you basically that your LLC is separate from your tax classification. Or another way to put that would just be that once you make an LLC, it doesn't make you a corporation. What it actually does is it's a legal classification that kind of separates your business as a separate legal entity. The tax classifications are separate. And so when you set up an LLC, by default, you're actually just a sole proprietorship unless you elect S corporation or C corporation status.
Yep, absolutely. S corps, they are pass through entities. So you would get the net losses or gains from your S corp through a Schedule K1 that you then put on your 1040 tax return. And that essentially captures your gains or losses that you have within your S corp company. Again, those S corp net income that is not having self-employment tax in there as well. So that's the big benefit of those.
And for probably 90% of businesses, an S-corp will be what you're going to want to choose. A C-corp is really for when you have international investors or you need to have more than 100 shareholders. So those ones definitely get more complicated. They also have different rules with, they can actually shift income and expenses to different tax years if they choose.
Sure.
And of course, there are rules that go along with that.
One of the big benefits too of the C corps is a lot of times the big corporations in terms of income, C corps may be beneficial to them. One of the big benefits of C corps is you can actually make donations out of your C corp, and those are business write-offs as well, as opposed to the S corps where they're not.
Gotcha. Okay. So, and the other thing with the S corp is kind of like you'll be able to stay a sole proprietorship until you kind of get to the, what do you say? Like,
I always tell people if you're around a net anywhere from 45,000 starts to make sense. I don't really like to go off of gross because you could, gross 100,000. If you spend 90,000 to make that your net income of 100,000 may not make sense to pay the S corp fees. Whether it be to us or another CPA or another firm. So we always like to look at converting our clients from a sole proprietorship to an S corp around when they get to that $40,000 net income range, because then essentially your S corp fees won't outweigh the savings, because at the end of the day we want to save you in taxes and we want it to be cost effective for you. So we never want to suggest moving to an S corp where you're going to have more accounting fees if those accounting fees aren't going to greatly save you taxes, especially the self-employment taxes that you would pay as a sole proprietor.
Right, and that really is a case-by-case situation. Because for example, if your business is like your side hustle and you're still getting paid with a W-2, you might already be paying the self-employment taxes through your W-2. So it might not make sense to do an S-corp election. And that's something that our tax planning services are really helpful for. We'll make sure to kind of really do a deep dive and make sure that it's a good choice for you, because we definitely wouldn't want you to pay a fee that doesn't even really make sense for your savings.
Sure. And with the S-corp, it does come, more responsibilities. You are required to have shareholders payroll, and there's more red tape to go through as the S-corp. Of course, with the S-corp, you are going to file two separate tax returns now. You're going to file the business tax return and the personal tax return. So you are no longer combining everything all on the 1040 like you would as a sole proprietor.
And it keeps it simple because of the pass-through aspect
Yep.
of it. You still only need to make one final payment to the IRS or to the state that you live in. And I think that makes it just easier on the taxpayer.
Sure, absolutely. So to kind of go into more detail of the S corps and whether S corp, C corp, partnership that you file a 1065 tax return, we can't stress enough how important tracking your business expenses are. Here at TCPA PLC, we use QuickBooks Online. It's the most user friendly. Our staff is very well trained on it. So that we only work within QuickBooks Online. And again, how that would work is, you sync your bank accounts with QuickBooks Online. I know you can speak in more detail about that, but it's essentially your business credit card that you use. You want that synced with QuickBooks, so every single time that card gets swiped, that expense gets captured and categorized and put into your profit and loss, just to make sure none of these expenses are falling through the cracks. Because at the end of the day, you're going to pay tax on whatever that net income is. So we want to come up with all possible business deductions to lessen that taxable income at the end of the day.
Yeah. And also, just to kind of get on a soapbox for a sec, make sure to keep your personal expenses separate from your business expenses. Can't stress that enough.
Yep.
Sometimes, we'll get books and it'll be 60% personal expenses. And so that can be a really frustrating process, because then we need to bug you about it and try to find out, okay, is this a personal expense? Is this a business? We have to go through transaction by transaction and get that figured out. So that's why getting that business bank account, as we've discussed in previous podcasts, is so important. And then making sure that you only use that business card or associated credit cards for business purposes only.
Yep.
That just makes it a little bit easier. Additionally, with those expenses, there's always going to be gray areas, and make sure that, just to reach out and try to find out, is this something I can keep putting on the business?
Sure.
Because people sometimes get a little excited when they do start a business, and they want to write off their trip to Disneyland and their Netflix and their Hulu account, and things that they were paying for before they had a business. And that's kind of what I tell to clients is, if it's something that you would have paid for without a business, you probably shouldn't be writing it off.
Sure. And I tell my clients on the other side of the coin is, part of our job is helping you establish the narrative of why that is a business expense, why it is ordinary and necessary for you to operate your business. So that's why, again, the tax planning piece of it's super important. So, we can have that conversation with you. A good example would be, say that you buy, a bunch of clothing. Clothing in and of itself is not a business write-off. Now, if you take that clothing to your embroidery and, get the company name put on them, you buy hats, you get any screen print done, that is a way to then take those clothing expenses as a business write-off, because you are making that an ordinary and necessary purchase for the business by putting your business name on it. So it's all about structuring those expenses in a way that if you were to be audited, you definitely have enough supporting documentation on why you took that expense.
Right, and it saves kind of those. But Jordan, I need to get a haircut because I'm a salesman, and my
Sure.
how I look is really important. It kind of just ask yourself that question first
Sure.
of did I need haircuts before I got into this business? Yes,
Sure.
you did.
Sure. Yep.
So
Absolutely.
kind of prevents all that.
One of the other, big pieces of the tax planning is, when we go through somebody's adjusted gross income and taxable income, one of the big kind of mystery expenses is always that qualified business income deduction.
Mm-hmm.
It's crazy how many times I see previous year tax returns and that is not taken, for whatever reason, whether you didn't have that conversation with the accountant or they just weren't aware of it. The big part of the QBI deduction is you can deduct up to 20% of your income. That was in the Trump tax law changes in 2017.
Right. And the laws associated with that are a little nuanced. So you're not necessarily guaranteed that 20%.
Mm-hmm.
It might be a calculation that you get part of the 20%.
Sure.
And that's something that we can definitely help you out with. But that's a big one. That really the main thing is just to make sure that everything is reasonable and necessary. All of your expenses are reasonable and necessary. And that you keep your receipts.
Another one that I've found, especially this year, bringing on, I guess you can call it more, not high level clients, but more clients that have larger incomes.
Right.
One of the big credits that I see that goes missed is the R&D credits. So the research and development, depending on what your business is. That's why the tax planning piece of it's super important to let us know, behind the scenes, the expenses that you make. And again, why the bookkeeping is important, because if you're looking through the books and you see that can then have you chat with me, we all get with the client, and then kind of see how we can get them eligible for some of those credits that maybe normally they wouldn't have taken if they hadn't communicated that to us or we didn't see it on the books.
Right. And yeah, categorization is really the most important step in this process, and it can be tricky because there's so much gray area. And just to kind of list off a few of the most common deductions, we've got the home office deduction. Auto expenses, usually we'll use the mileage reimbursement, equipment and supplies, advertising and marketing, travel expenses, healthcare premiums, retirement contributions, salaries and wages, professional fees, and utilities. So, if you have any of those and you haven't been keeping the receipts, go ahead and start doing that. We can help you out. Just wanted to touch briefly on the home office deduction, because once again, when you start a business, you're like, let's write off everything. Let's write off the house, Netflix account, pair of Crocs I just bought.
Because I wear those when I'm working.
I wear those.
Those slippers is what I wear, and I feel comfortable when I take calls online. So that is a business expense, right?
Or that Disneyland trip that you talked about it at work to your coworker.
Well, when I was in line waiting at Magic Kingdom, I talked to the attendant about why they should invest in real estate and why they should, get their taxes done with us. So I don't think that's how it works.
Right. And so for the home office deduction, what we'll end up asking you for is the square footage of the portion of your home you use as an office. And then what's going to happen is basically your utilities will be prorated. So a proportion of them or a portion of them will be used for your expenses on the business, and then the rest will be used just like an itemized deduction, like normal. But there's a few that are there's a few of those that you can already take on the itemized side, and a few of those you can only take on the business side. For example, as an itemized deduction on your individual return, you can't take utilities, but you can take the portion of your utilities you used as your home office.
Correct.
And so that's where, putting this all on a Schedule C doing it the right way can really pay off is there are deductions that start to come up that really were stuff you paid for personally, but now you can allocate a portion of them to write off your business income.
Sure. And one of the big important pieces of it is not only the expenses, but the timing of those expenses. Maybe we're with all of our business clients, we at minimum tax plan twice a year. We do mid-year tax planning and end of the year tax planning. Mid-year tax planning, a lot of times that's getting the more sophisticated things set up, 401ks. We could even, for high income earners, talk about defined benefit plans. Towards the end of the year, it's allocating the time of those expenses. So say that, you have an office and everybody needs new computers. It may be more advantageous that you buy those in December in that tax year to offset income that that you have, as opposed to waiting until, January, February of the next year. Then you don't get to take those expenses until the whole next tax return year.
Right.
So the timing of some of these business expenses is just as important from a tax planning perspective to know when is a good time to buy things that maybe you don't need right now, but you're going to buy anyway. So if you're going to buy it anyway, you might as well buy it in the tax year that would be most advantageous for you to buy it.
Right, and I think one of the biggest big purchases that people end up making is a vehicle.
Yep.
For their business, and there's a lot of moving parts there. The depreciation is really important because you'll be able to take that
Sure.
depreciation year by year. It spreads it out so that you can write off your income over more years and get into lower tax brackets.
Yep.
One thing to keep in mind, though, is if you sell the vehicle down the road, there is a depreciation recapture tax. So make sure to, before you kind of impulse sell a vehicle, make sure that that's a valid decision, that's a good choice for your business.
Numbers on the vehicle, the bonus depreciation now is 80% in 2023. It'll drop down to 60, supposedly 60, 40, 20, and then stay at 20.
Wow.
And the depreciation recapture tax is 25% of the full depreciation that you've taken. So that also will go into taxable income, that 25% of the depreciation recapture tax.
Yeah, and that's completely separate from what you would have to pay on if you got like a capital gain from it as well.
Yep,
so definitely
absolutely.
Something to keep track of. If you don't want to, go through that process of putting the vehicle on your business as an asset, you can also just take the mileage deduction. That's something that's super common. And for a lot of people, it actually makes more sense.
It does.
So, make sure to make that decision early on. Once you do decide if you're going to take the mileage deduction or write off the vehicle itself and use actual expenses, you have to stick with one or the other for the remainder of that asset being associated with your business.
And last point on the vehicles, that bonus depreciation, it is vehicles over the 6,000 pound limit. So that's something else to keep in mind, that you buy a Ferrari, but what if I put it in all my videos?
Right.
I know here internally it is at minimum 50% of the use of that has to be business. Even at that, putting it on your videos, it's still an expense that could cause a red flag. So it's definitely good to consult with your CPA, your tax advisor, just so they can get the full scope of how that vehicle is being used. And again, it's creating the narrative of why you're taking that as a business expense. That's almost more important than just buying it in general.
Exactly. And I feel like that law was sort of designed for like a work truck. Like that's kind of the ideal.
It was originally imposed for farmers. That's how it was originally started.
That makes sense.
For farmers having their large heavy machinery, and it was supposed to be a kickback. And crazy how the trickle down effect has happened from it started with farmers, and now YouTubers are buying G-Wagons and writing them off. So it's really come full circle on a trickle down. So
And it really just smooths out your tax bracket if you can spread out that depreciation versus if you just take the full expense of the vehicle in the first year. Then what happens is you're in a low tax bracket the first year, or maybe you don't pay tax at all, and then it's the high tax bracket. So it really is nice to have a smoother ride as you move forward with your business.
Yep, absolutely.
But I think that's probably good for this video.
Yeah, the again, to circle back and wrap it all up, it's the communication between, your CPA tax advisor and yourself. It's a half-hour meeting can go a long way in saving you thousands, if not tens of thousands of dollars. So again, we can't stress how important that is. I know here in our office, our clients get repetitive emails to schedule tax planning meetings. So at the end of the year, the ball's always in the client's court. We can always go back and say, you got these 14 emails throughout the year. You've clicked on them multiple times. You haven't scheduled. So that's kind of how we run our office here personally. So again, it's the communication piece of it, just so everybody's on the same page, because we really can't best advise unless we know, the specifics behind your business, expenses, and, where you see your business projected, not only at the end of the year, but going into the following year.
And we're always here to help.
Catch you on the next podcast. Thanks, guys.
Like, comment, subscribe.